Silver's rise has been so powerful, so persistent, and so convincing that many investors now assume its strength is unshakable. Yet history suggests that moments like this are often when markets become most fragile. As 2026 opens, silver stands at the center of a contradiction few expected to see, where strong fundamentals coexist with growing instability beneath the surface. One of the most influential institutions to address this tension is HSBC, a global banking giant whose analysis carries weight precisely because it avoids exaggerated predictions. Headquartered in London and operating across more than 60 countries, HSBC has spent decades tracking commodity cycles, building a reputation for cautious interpretation rather than emotional forecasting. Its latest outlook on silver does not fit neatly into bullish or bearish camps. Instead, it presents a divided picture, one that acknowledges powerful forces supporting prices in the near term while warning that those same forces may be sowing the seeds of turbulence later in the year. This perspective matters because silver is not behaving like it did in past cycles. Price action over the last year has defied traditional expectations, catching both skeptics and optimists off guard. According to HSBC, the foundation of silver's recent resilience lies in a condition known as physical market tightness. This refers to a situation where actual, deliverable silver metal is scarce relative to demand from buyers seeking immediate settlement. Unlike paper contracts or futures positions, physical silver must exist in vaults, ready for delivery. Today, availability remains constrained across the most important pricing centers in the world, including London, New York, and major Asian hubs. The London Bullion Market Association continues to report pressure on vault inventories, signaling that supply buffers remain thin. At the same time, registered silver stocks at the COMEX exchange in New York have fluctuated at levels that concern professional traders. When inventories shrink to this extent, the market loses flexibility. Even modest increases in demand can trigger outsized price reactions because there is little excess metal available to absorb buying pressure. This dynamic explains why silver prices have responded so sharply to relatively small waves of demand in recent months. In a well-supplied market, such buying would pass almost unnoticed. Under current conditions, each new buyer must compete for a limited pool of metal, driving prices higher through simple scarcity. HSBC highlights that this tightness has also altered the character of pullbacks. In previous silver rallies, sharp advances were often followed by deep corrections that erased large portions of the gains. This time, declines have been shallow, with buyers stepping in quickly at levels that would have seemed unrealistic only a few years ago. That behavior reinforces confidence in the market, but it also creates complacency, a condition HSBC views with caution. Beyond supply constraints, silver's industrial role provides another layer of support that distinguishes this cycle from earlier ones. Unlike gold, which functions primarily as a store of value and a jewelry metal, silver is deeply embedded in modern industrial systems. Its physical properties make it uniquely valuable. Silver has the highest electrical conductivity of any element, surpassing copper, which is used more widely only because it is cheaper. In applications where performance and efficiency matter more than cost, silver has no true substitute. One of the fastest growing sources of industrial demand comes from solar energy. Photovoltaic cells rely on silver paste to conduct electricity, generated when sunlight interacts with semiconductor materials. Each standard solar panel contains approximately 10 to 20 grams of silver, depending on design and efficiency targets. Global solar capacity additions exceeded 300 gigawatts in 2024, marking a dramatic acceleration compared with earlier years. According to projections from the International Energy Agency, solar installations are expected to continue expanding throughout the remainder of the decade, driven by climate policy commitments and improving economics. This demand exists regardless of investor sentiment, providing a steady baseline of consumption that does not disappear during market corrections. Transportation electrification adds another powerful demand stream. Electric vehicles require significantly more silver than internal combustion vehicles due to their complex electrical architectures and control systems. A single electric vehicle can contain between 25 and 50 grams of silver spread across wiring, connectors, and battery management systems. Global electric vehicle sales surpassed 17 million units in 2024, and growth is expected to continue through 2030. Together, these industrial uses create a structural demand foundation beneath silver prices that did not exist at comparable scale during earlier speculative episodes. HSBC views this foundation as real and durable, yet it also warns that strong fundamentals do not guarantee smooth price behavior. In fact, they often invite speculation, setting the stage for volatility once optimism becomes crowded. As HSBC shifts from explaining why silver has remained resilient to outlining why that resilience may not last uninterrupted, the tone of its analysis becomes more cautious without turning outright negative. The bank is not pointing to a single event capable of collapsing the market overnight. Instead, it focuses on how silver's success has attracted behavior that historically increases instability. Markets rarely fail because fundamentals suddenly vanish. More often, they falter because positioning becomes crowded and expectations rise faster than reality can support. Silver AS, advanced through late 2025 and into early 2026, has drawn in speculative capital at a pace not seen when prices traded far lower. Traders who ignored silver below $20 per ounce became interested as prices crossed 30 and approached historical highs. This shift matters because speculative participants behave differently from long-term holders. They respond quickly to price movement, amplify trends through leverage, and exit just as quickly when momentum fades. HSBC points to futures markets as the clearest window into this behavior. In these markets, traders control silver contracts worth many times their initial capital through borrowed funds. The Commodity Futures Trading Commission publishes weekly commitment of traders' reports that reveal how different groups are positioned. Recent data shows speculative long positions elevated relative to historical norms. This means a large portion of market participants are betting on further price increases. While that can push prices higher initially, it also creates vulnerability. When too many traders are positioned on one side, the market develops what professionals describe as a top-heavy structure. In such conditions, the pool of potential new buyers shrinks because many have already entered. Meanwhile, existing positions become a source of potential selling pressure. Any disappointment, even a mild one, can trigger profit-taking. HSBC emphasizes that the catalysts for reversals in this environment do not need to be dramatic. Economic data that simply meets expectations may fall short of what momentum traders hope for. Central bank statements that maintain current policies rather than introducing fresh stimulus can disappoint markets priced for acceleration. Because many positions are leveraged, even modest price declines can force traders to sell in order to meet margin requirements. This forced selling is mechanical, not emotional. Traders sell not because their long-term outlook has changed, but because they must reduce risk immediately. As prices fall, additional participants rush to exit positions preemptively, creating a cascade effect. HSBC describes this process as volatility feeding on itself, where price movement generates further movement independent of fundamental news. Once such cascades begin, declines can extend far beyond what underlying supply and demand would justify in isolation. After addressing speculative risks, HSBC turns to the supply side, where subtle shifts could also influence price dynamics later in the year. Global silver mine production runs near 830 million ounces annually, based on data from the Silver Institute. This output comes from two sources: primary silver mines and byproduct of production from copper, lead, zinc, and gold operations. Only about 30% of global silver supply originates from primary silver mines, which limits the industry's ability to rapidly increase output in response to higher prices. However, byproduct supply responds to the economics of base metals mining rather than silver itself. When copper, lead, and zinc projects expand, silver output rises alongside them. HSBC notes that mine supply could stabilize or increase modestly in the second half of 2026 as projects delayed during lower price periods move into production. Mexico, the world's largest silver producer, has several projects approaching operational stages. Peru, the second largest producer, has also seen renewed investment aimed at expanding silver output at existing operations. These developments are unlikely to create oversupply, but they could reduce the extreme tightness that has supported recent price strength. Recycling represents another supply channel that responds to sustained high prices, albeit with a delay. When silver prices remain elevated for extended periods, material that would otherwise remain dormant enters recycling streams. Old jewelry, industrial scrap, and silver-containing household items become economically viable to process. HSBC estimates that recycling volumes typically increase within 12 to 18 months of sustained high prices. During the 2011 silver spike, when prices briefly exceeded $49 per ounce, recycling rose sharply. While current prices are lower than that peak, they have been high for long enough to encourage increased recycling activity. Producers also respond to favorable pricing through hedging programs. These involve selling future production forward at current prices using derivatives and options. Hedging effectively brings future supply into the present, increasing near-term availability. HSBC highlights this behavior as another factor that could gradually ease tightness conditions. None of these supply-side shifts signal collapse. Instead, they point toward normalization. When combined with heavy speculative positioning, even modest normalization can have outsized price effects. This is the paradox HSBC identifies. Strong prices encourage behaviors that ultimately weaken the conditions that supported them. The result is a market that remains fundamentally supported, yet increasingly unstable, where volatility becomes the dominant feature rather than direction. In such an environment, price swings can feel disconnected from news, leaving many participants confused. HSBC's analysis suggests that this confusion is not a failure of fundamentals, but a reflection of how crowded positioning and delayed supply responses interact once optimism peaks. To translate HSBC outguess analysis into practical takeaways for investors requires a mindset that goes beyond simple bullish or bearish labels. The bank is not predicting a silver collapse, nor does it suggest that the metal is fundamentally weak. Its message is more nuanced. Silver remains supported by both industrial demand and structural supply limitations, yet its recent strength has created conditions where volatility is likely to dominate. Understanding this distinction is crucial for anyone holding or trading the metal in 2026. Silver continues to have compelling reasons for elevated pricing relative to historical norms. Industrial demand remains on a strong upward trajectory, powered by energy transition, electrification, and technological advancement. Solar panel production alone consumes hundreds of millions of ounces annually, and global electric vehicle manufacturing continues to expand, requiring tens of grams per vehicle. Advanced computing and data centers supporting artificial intelligence also rely on silver for electrical conductivity. Physical demand like this acts as a floor, preventing the kind of complete collapses that have occurred in some past cycles. At the same time, speculative positioning, leverage, and supply normalization can create ceilings, capping rallies before they reach blow-off levels. Between these limits lies a range where silver prices may fluctuate for months, oscillating based on trader behavior rather than fundamental news. HSBC warns that this year is likely to punish complacency. Easy gains from parts of 2025 are unlikely to repeat. Volatility will extract its toll on participants unprepared for rapid swings. Investors focused on monthly or quarterly performance may find themselves frustrated or even unprofitable after accounting for transaction costs. Conversely, those with multi-year horizons can use volatility strategically, adding exposure during panicked sell-offs. This requires capital reserves and emotional discipline to act when others are selling. Position sizing becomes critical. Allocations appropriate for calm markets may be impossible to hold through large intraday or weekly drawdowns. Experienced precious metals investors often focus on maximum drawdown tolerance rather than simple percentage allocations. This acknowledges that the psychological challenge of holding through volatility often exceeds the analytical challenge of identifying opportunity. Time horizon is equally important. Investors focused on short-term returns may feel whipsawed by volatile swings that reflect speculative positioning more than fundamentals. Longer-term investors can potentially leverage these swings to their advantage. HSBC's institutional perspective provides something rare in commentary, a frank acknowledgement of complexity. Markets rarely conform to clean narratives. The silver market entering 2026 embodies this complexity, simultaneously supported by physical and industrial demand while challenged by speculative dynamics and emerging supply adjustments. Within this environment, volatility becomes the defining characteristic, often more influential than direction. The coming months will test whether industrial demand can absorb waves of speculative selling. Solar installations remain at record pace, directly consuming hundreds of millions of ounces. Electric vehicle production accelerates, replacing internal combustion models with architectures that require more silver. Computing infrastructure supporting AI and other technologies further drives consumption. These demand factors operate independently of hedge fund positioning or short-term sentiment, providing a structural foundation beneath prices. Yet, over shorter horizons, speculative behavior will likely dictate price action, frustrating participants who expect prices to track fundamentals directly. In practice, market behavior reflects the psychology of participants as much as economic realities. HSBC's analysis acknowledges this psychological dimension, while reminding investors that fundamentals will assert themselves over time. For those holding silver, the main lesson is that volatility, not direction, will dominate. Traders and investors must prepare for swings that can exceed 5% in a single session, both up and down. Rallies of similar magnitude will also occur, creating opportunities for disciplined, experienced participants. Less prepared investors risk being shaken out at precisely the wrong moment. Understanding leverage and margin requirements becomes critical. Speculative long positions built during the rally create latent selling pressure. Even minor disappointments can trigger forced selling, which can cascade into larger declines. Physical market tightness may moderate as new mining projects come online in Mexico and Peru, as byproduct supply increases, and as recycling activity rises in response to sustained high prices. Hedging programs by producers to near-term supply, increasing the potential for volatility. Yet, the same fundamentals that underpin silver's price provide a floor, preventing complete collapse. HSBC frames this as a paradox. The very forces that support silver also generate conditions that make prices less predictable and more vulnerable to sudden swings. Investors must reconcile these opposing realities. The bank's message is clear. Silver will not move smoothly. Daily and weekly price swings are likely to be larger than in previous cycles. Long-term investors can benefit if they understand the rhythm of volatility and act strategically. Short-term participants may struggle if they misinterpret price action as a reflection solely of fundamental change. Ultimately, HSBC emphasizes discipline, risk management, and position sizing as the most important tools in navigating the market in 2026. A calm approach, patience, and emotional control are more valuable than simply betting on a directional move. Markets that appear strong can unravel quickly, while fundamentals that seem vulnerable may provide unexpected support. Silver's current rally embodies this duality. Those who respect it may find opportunity. Those who ignore it may experience losses amplified by leverage and volatility. Understanding the interplay between industrial demand, physical supply constraints, speculative positioning, and emerging supply moderation is the key to successfully navigating the months ahead. By framing silver's market dynamics in this comprehensive manner, HSBC provides investors with a roadmap that acknowledges complexity rather than offering simplistic predictions. This is not a market for complacency. The combination of strong fundamentals, speculative positioning, and evolving supply conditions creates a high-stakes environment where volatility dominates short-term outcomes. For serious investors, recognizing these patterns and preparing accordingly will be the difference between opportunity and unnecessary risk. 2026 will not reward those who assume that strong momentum guarantees stability. Instead, it will test participants' discipline, foresight, and understanding of how success can paradoxically create vulnerability.